Welcome to this video. Today we're going to do a deep dive stock analysis on AMC. AMC is the biggest cinema chain in America and one of the original meme stock legends. It's now trading near its lows and you can see that volatility is rising again. And also the investor interest is starting to return. So could this be a massive buying opportunity right now? Let's find out in this video. AMC is primarily a movie theater company. And they make the money through their ticket sales, but also through food and drinks and popcorn, which actually have the highest margin, which is interesting. We're now looking at the charts of AMC on TradingView, and we can see it's trading right now at $2.46. And you can see that the 200 EMA is above the 50 EMA, so we're clearly in a downtrend right now. But the price looks a little bit oversold, and it seems that it's making a double bottom, which is a pattern that often happens. So the stock is down over 99% from previous highs. So we're going to find out what the fundamentals are of this company, whether it is cheap or expensive, and whether this could be a buying opportunity at the moment. Let's look at the fundamentals of AMC Entertainment Holdings. Here we can have a quick overview. For example, we can see that the financial strength is not really strong. They have a lot of debt, and they try to get rid of the debt by issuing new shares, but this dilutes the shares, and that's also why the stock price has gone down so much. Financially, they're not really strong. So are they profitable? Also not really. Their net income is actually negative. So the debt is going down. They slightly get rid of debt by diluting the shares through creating new shares and then selling it to the market. And that's also why the stock price collapsed so much. And here we can see that the revenue, it went up, then it went down during the pandemic, of course. And you can see that the revenue is actually going up in the last few years, which is great. Here you can see. So here we can see the income statement of the last year, and it's not that horrible. We can see that the revenue is 4.6 billion and the gross profit is 3.1 billion, so 66.7%. That is great. That means that the COGS, cost of goods sold, is not really expensive, especially like those drinks and foods, very cheap to buy. And they sell for massive margins. That's why the gross profit margin is pretty good. But the operating expenses are a lot, and that's why they still end up with a negative net income of 352 million. So AMC has fallen a lot in the last few months, years, and it seems to be very low priced. And often when that happens is people become scared and bearish. But if we look at the sentiment, it's pretty neutral right now, which is interesting to see. In order to know whether AMC is cheap or expensive, we can look at the price to sales ratio. The price to sales ratio is market cap divided by revenue. So market cap is the price and then sales is revenue. So this tells us how much investors pay per dollar of sales. So here on Finviz, we can look at AMC and we can see here the price to sales ratio of 0.25, which is really low. That's why it's also in green. So if we compare the price to sales ratio with its peers, you can also see that if you compare to IMAX, it's 4.5 to 5 and Lionsgate 0.4 to 0.6. So compared to the competitors, it's also really, really cheap, which is great. So we're now looking at alphaspread.com and they did an intrinsic value calculation of AMC Entertainment Holdings. And they used a discounted cash flow method and a relative value, and they took the average. So the intrinsic value of one AMC stock under the base case scenario is $8 compared to the current market price of $2.39. AMC Entertainment Holdings Inc. is undervalued by 71%. So according to this source, it could also be very undervalued at the moment. So let's talk about the latest earnings of AMC. And we can see that the earnings, so the net income for the quarter was negative, and it was much more negative than the reported. So it's a surprise. The revenue was pretty good and it was higher than the reported revenue, which is great. So we're now looking at the AMC Entertainment Holdings report, the third quarter and the results. And we can see that the revenue was 1.3 billion compared to 1.348 billion for quarter 3 2024. So the revenue went down, but it was still higher than the expectations. So there was a big net loss of 298 million compared to the net loss of 20 million for quarter 3 2024. But the increased net loss stems primarily from non-cash charges. So basically assets that were less valuable than they anticipated. And it's a write-off It's not something that will be in the next quarter, probably. The earnings weren't good, but they were also not too bad. And the chairman and CEO of AMC, Adam Aron, is still quite positive. He said the third quarter industry-wide softness should not be a cause for alarm, nor a hardening of some negative trend about which to worry. To the contrary, we expect the fourth quarter industry-wide box office will turn out to be the highest grossing fourth quarter in 6 years. So he's still very optimistic. I believe that AMC can give a positive risk reward. It either go bust or it can tenfold or even much more than that. And that's why I only would allocate a maximum of 2% allocation, because this stock is extremely volatile and the fundamentals aren't too strong. But even if you allocate a small percentage, like 2% to your portfolio, then it can still give you a lot of returns if this go well. And it's also easier to diamond hands if things go to the moon. In order to know if this company can turn around and become profitable again in the future, it needs to be in an industry where there is a growing demand. Well, the movie theater market isn't like a really strong high CAGR market, but it still grows with 5% according to this article. And you can see that North America remains the largest market for movie theaters. So who are the major players? AMC, Cinemark, Regal Entertainment, Cineworld. So AMC is one of the top players, but the compounded annual growth rate expected of 5% is not too high, but I think it's enough to make it possible to become profitable again in the future. So some investors are wondering, could there be a next short squeeze? A short squeeze is essentially when short sellers need to buy back their own shares, and that create a positive feedback loop which drives the price even higher. And that happened to GameStop and also to AMC many years ago. And could this happen again? Well, here we can see that the short percentage of float is around 9.64% at the moment, which is not too high. However, the short interest ratio is 1.6 days. So it takes 1.6 days to cover everything. That's still plenty of time, which means that there could be a short squeeze coming, but not like really huge. In short, I'm not expecting a massive short squeeze, but there still can be a small form of short squeeze because the short percentage of float is not too high at the moment. We're now back at the charts again. It's now trading at $2.38. And we are now zoomed out on weekly candles. And we can see that here the massive short squeeze, it went up like thousands of percent. And now it's basically all-time low. Do I think they can go to all-time highs again? I don't think that's possible. But do I think they can go back to like $30? Yeah, that should definitely be possible if they find a way to turn around this company, and then this company can still give a high return. I only allocate a very small percentage to AMC of my portfolio because this is still a very risky stock. But I do believe that this is a high risk, high reward stock. And if we allocate only a small percentage of our portfolio to this stock, then we can still, and it goes well, then we can still make a lot of money. I hope you learned something today. Always do your own research, always do your own due diligence. If you like this kind of content, feel free to like and subscribe for more. And I will see you in the next video.